Thank you all for taking some time this morning. Do appreciate the attendance. These webinars seem to be very popular, but for anybody who doesn't know, my name is James Bogart. I am President and CEO of Bogart Wealth. Today's talk, we're going to talk about how discount rates affect the ExxonMobil lump sum. Real quick introduction to Bogart Wealth. Bogart Wealth is what's called a registered investment advisory firm. We're fee only. We are currently managing approximately $980 million of client assets. It's about 700 households. About 90% of them are ExxonMobil households, so high level of proficiency with the ExxonMobil benefit programs. We are true fiduciaries for our clients. Means we're legally obligated to put your interest above our own. I have 16 folks as part of my wealth management and planning team. I also have 4 folks as part of my tax team. And our core competencies are financial planning, investment management, tax optimization, and tax preparation. We have 3 office locations, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. You'll commonly hear me say, but what would you do differently now that you know what you know, but back in your 20s or 30s? So one of the calls to action from any of the events that we do is to actually offer to sit down and run your numbers. It's absolutely no cost, absolutely no obligation. We use it as a great way of introducing ourselves to you and providing some very valuable input. One of the conversations we're going to have is related to the pension and lump sum options you have available to you. Highly recommend you take advantage of that opportunity. My team on the back end of this is going to reach out, and please feel free take us up on the opportunity. A couple administrative things before today's talk. I do have the chat as well as the question and answer box open if there's any questions that come up. I also am recording this. It's going to go on the website. If you happen to miss anything or like to re-listen to it, please let us know. Delighted to send out the recording. So today's talk is actually part of an 8-part series that we originally started doing. We called our Retirement Readiness series. But we have different presentations. We do different topics. We have been doing all of these lately. They're all recorded. They're all up on our website. So please feel free to take advantage of looking at those. But we do one on the retirement planning timeline, one on retirement income planning, one on Social Security and Social Security strategies, one on tax law and tax optimization strategies, one on estate planning strategies, one on net unrealized appreciation, NUA, and post-retirement income strategies, one on long-term care and long-term care insurance, one on Roths versus traditional 401ks and IRAs, and we also do one on mega backdoor Roth conversions now as well. We've been adding to this list, adding timely different topics, things that people have asked us to. If there's something you'd like to hear us talk on, at a minimum, I'll add it to an existing presentation, but I'm also happy to just do a shorter presentation just on that topic as well. All right, so today we're going to talk a little bit about discount rates related to the ExxonMobil lump sum. In order to get there, first we need to introduce what's called the Pension Protection Act of 2006. Now this is actually a series of guidelines that came out related to any company that's offering a lump sum option on their pension program. It defines the discount rates that are going to be used. It also defines the actuarial tables going to be used. And then a couple things not necessarily related to the lump sum that the Pension Protection Act also did, but it clarified that non-spousal beneficiaries can do rollovers. It clarified that after-tax balances that are in 401k plans can actually roll over to Roth IRAs. It introduced diversification of company matches. So many of you might have known that prior to 2006, to get the extra 1% on the ExxonMobil match, you had to have it all go into stock. The Pension Protection Act is the reason for why now it's still stayed at 7% until they recently discontinued it, but you were then able to diversify it. And then lastly, it also defined IRA as well as 401k contributions. All right, so the reason that I introduced the Pension Protection Act is because it actually created 2 different age groups within the ExxonMobil pension program. Those that were grandfathered and then basically everybody else. Now, in order to be grandfathered, you had to be over the age of 50 with more than 10 years of service before January 1st, 2008. A couple other ways of describing it is you were 55 and had 15 years of service by December 31, 2012. You were born prior to 1958 and hired before 1998. Now, the math for this age group is actually relatively simple to calculate. We take 95% of the entire quarter's balance of the 30-year Treasury rate. They round it up or round it down to the nearest quarter point. The other thing with this age group is we use the ExxonMobil year 2000 mortality table. So that mortality table has not been updated in 20 years. Now, what we know with Treasuries is they've, over the last 30 years, been on really a pretty significant downtrend. Actually, a little longer than that, 40 years, been on a pretty significant downtrend, and we are now at new historic lows. So in terms of projections for the first quarter, we are modeling that they are going to be, well, we know now, they haven't been announced, they'll be announced next week, but we know that they are going to stay flat at where they were in the fourth quarter, which is down to 1.25% for the discount rate. By the way, for both age groups, every single week we send out pension projection updates, what we're estimating these discount rates to be at. If you're on that list, please feel free to share it. If you're not on that list, please feel free, send us a note. Happy to add you to the list. We're delighted to kind of give that information away. All right. So for the other category, this is anybody else. So you were under the age of 50 as of December 31, 2007, or you were born after 1957 and hired after 1997. The math is a little bit more complicated, and we are finding that most of the employees who are now retiring are in this age group. But for this age group, you use 3 segmented rates that are all based off of high quality corporate bond rates. Segment 1 is replicating short-term bonds. Segment 2 is replicating intermediate term bonds, and segment 3 is representing longer term bonds. I'll talk about the 3 in a second. But the other thing with this age group is they use the IRS mortality table, which is updated every single year. So as I mentioned with the grandfather category, they're using the year 2000 mortality table. For the all other category, they're using the updated rates. Now, what we've seen with these 3 segments, so as I mentioned, segment 1, segment 2, and segment 3, I have an example that shows the calculation here in a few minutes, but the concept is that if you have this annuity stream and you decided to take a lump sum, you would then need to replicate it and turn it into an investment vehicle. And so what they did with interest rates was segment 1 applies to the first 5 years of your pension program. Segment 2 applies from years 16 to 20, and then segment 3 applies to everything else. So segment 2 does have the most significant influence in terms of what the effective discount rate is. Now, what we also know is that the fourth quarter rates were the lowest they've ever been, and we're modeling projections for what the first quarter of 2021 is going to be. And we are now seeing that they are actually trending to be at a new historic low. Our models are saying that the blended average of the rates are actually going to be about 2.32% for anybody who's retiring at the age of 60 and about 2.47% for anybody who's retiring at the age of 55. So it's anywhere from a 37 to a 39 basis point decline is what we're modeling. Again, we will get the official rates when the IRS publishes them next week. I'm anticipating it's going to be the morning of October 16th. As soon as we know those official rates, we'll be sending out a note as well. But either way, the trajectory is still down. Historically, our models have been very close in terms of what the projections have been. You know, recently the Fed has been very active in the corporate bond space, which is actually causing a little bit of the delta that we've had on our models. But that said, I do believe that the first quarter discount rates are absolutely going to be lower than what we saw in the fourth quarter. Was the old grandfathered way better or for older employees or the new way? You know, truthfully, better. You know, corporate bonds historically are higher rates than the Treasury rates. And that is still the case, although, you know, what I would say is if you just look at the numbers, the discount rate for grandfathers 1.25% versus a 60-year-old who's retiring in the first quarter, it's at 2.32%. So the rate is higher. So corporate bond rates means higher rates, which means smaller lump sum. Now, one thing that I would point out in terms of the difference between the age group is that mortality table. The year 2000 mortality table, again, has not been updated in 20 years. As people have been living longer, the mortality table now being updated is implying longer mortality, which is actually offsetting some of the differential between the two. But at the end of the day, these rates were determined based upon what your birthday was if you were working for the company prior to 1998. So you can't really change your birthday, to be perfectly honest. But you know, we're finding as employees have worked longer and longer, it's been to their benefit to stay longer. Another question that came in, is the difference between age 60 and age 55 for those rates caused by the mortality table? No, it's actually not. So as I mentioned a few minutes ago, the way that they apply the discount rates is the segment one, which listed right here is at 0.5. We're modeling it to be 0.51% for the short-term bonds. That applies to the first 5 years. Segment two, which we're modeling to be 2.24%, that applies to the next 15 years, so years 6 through 20. And then segment three applies to everything else. Now, because segment three is long-term bonds, 3.07 is our projection. That actually, for somebody who's retiring at age 60, based on current mortality tables, has less exposure to segment three than somebody who's retiring at age 55. So the reason for the differential between the two is because someone who's retiring at 55 has 5 more years of exposure to the higher rates, which is what causes this blended average, or what we call the single rate equivalent, to be a little bit higher. Is the lump sum taxed at the time of distribution/retirement? That's a great question. So the answer is, there's, dependent upon where you're at in the company, there are different benefit programs for executives versus non-executives, and your compensation does come into consideration as well. For most employees, the qualified portion of your lump sum, so if you're making under $285,000 of compensation, all of that is categorized as qualified. Now that will roll right into, if you take the lump sum, right into a traditional IRA account, and that creates no tax at all. Now, if you're over $285,000 of compensation, you have something that's called a supplemental pension plan. Now, that is only available to you as a lump sum, and that portion is 100% taxable. And then if you're at the executive level, there's an additional benefit that's called the additional payments plan. That's also only available as a lump sum and is also 100% taxable. All right. Just wanted to quickly show kind of, ooh, a little trigger happy. Just wanted to quickly show what's going on with the projection. So we do know what the August rates are, and those three segments came in at 0.52, 2.22 for segment 2, and 3.03 for segment 3. We are still modeling out the projections for September. Does look like segment 1 came down a little bit, but segment 2 and segment 3 have come up a little bit. And again, we will have those official numbers next week. Now, one thing to note with the differences between the two age groups. Earlier, I mentioned with the grandfather category, we look at the 30-year Treasury rate for the entire quarter. So for example, to model out for the second quarter of 2021, October, November, and December will determine the second quarter for the grandfather category. For anybody who's in this other category, those discount rates are only built upon the last 2 months of each quarter. So for example, August and September are building out the first quarter rates. July had no impact. Now we're starting, as we're in October, October is going to have no impact on the second quarter rates. Second quarter is going to be determined based upon what happens in November and December. All right, a couple other questions came in. If an individual retires at 62 and is the rate lower than you would have shown at age 60? Yes, it is. These are just illustrative examples for somebody who would be retiring right on their 60th birthday, or somebody who's retiring right on their 55th. So in the example, if somebody's retiring at age 62, they are going to have less exposure to segment 3, which is actually going to cause that single rate equivalent to go down a little bit more, even for you. Could first quarter 2021 rates be the bottom? You know, that is a great question. In terms of these segments, you know, these the low for the corporate bond rates. You know, and I've been saying for a few years now that it's hard to imagine rates going lower. I would say that what's happening with rates right now is they are very heavily influenced by what's going on with the Fed. The Fed is committed through all of 2021 and into 2022 to continue to keep interest rates low. Now, since COVID happened, what really kind of stimulated a lot of the rate movement down is the fact that the Fed did start buying high quality corporate bonds. It's the first time in history that they've actually done that. Specifically talking about short-term bonds, but it's had a cascading effect over onto the segment 2 and a little bit on segment 3, but not very much. And as I mentioned earlier, segment 2 is the biggest influence. Thus far in the month of October, we have started to see a little bit of an uptrend. But again, as I mentioned a few moments ago, October has no impact in terms of what the rates are going to be for the second quarter. They're going to be built entirely off of November and December. At some point, if the Fed stops buying bonds the way that they have, we are going to see rates move, and probably a little bit more significantly in a shorter period of time. My crystal ball is not that good in terms of if first quarter is going to be the absolute low, but I would also say that if when it comes to making a decision around timing for retirement, you do always have the ability to delay commencement of taking your lump sum option. And the nice part about the math and the way the sequencing and the timing works, I'll show you an illustration in a minute, but we are going to know the next quarter's rates before you have to execute on the preceding quarter. So for example, right now, anybody who wanted to take the fourth quarter rates, the last possible benefit commencement date you could have is December 1st if you're in this all other age group category. The grandfather category, if they wanted the fourth quarter rates, they could go all the way until December 31st. But if you're in the all other age group category, which is most of the company at this point, December 1 was the last day that you were going to be able to execute or declare benefit commencement date and still get the fourth quarter rates. Now, that doesn't mean that you actually have to retire significantly further in front of that. I've seen scenarios where people will wait till the day before their benefit commencement date to announce their retirement. Typically, that doesn't give the company a lot of flexibility in terms of finding a replacement for you. However, if you declare it as late as November 30th, you could still get those benefits and have that December 1 BCD, but everything's going to be delayed in processing. Now, I will say at this point, because we are modeling interest rates to go lower into the first quarter, it makes sense to go ahead and push and wait and declare your BCD at some point for the first quarter. Now, in order to get that quarter's discount rates, your benefit commencement date has to be the first of a month, and it has to be on either January 1st, February 1st, or March 1st. March 1st is the latest that you're going to be able to get for the first quarter benefit commencement date. And to build that timeline out, let's say you wanted to use March 1. Well, March 1 means that your package needs to be back to benefits by January the 25th. And similar to what we're experiencing right now for anybody who was using a December 1 benefit commencement date, well, that package, again, January 25th, we're going to actually know the second quarter rates before that package is required to get back. So we have a lot of clients that play the interest rate waiting game and delay taking their lump sum because rates have been on this down trajectory. And especially if you're under the age of 60, if you're under 60, ExxonMobil is imposing a roughly 5% per year penalty, early commencement discounts, what they call it. But if you're under the age of 60 and rates are trending flat or down, it makes sense to wait. Now, if you're over 60, the actuarial tables are starting to move a little bit against you. And the only reason you'd want to really leave it there is if you think rates are still going to be trending down. So a lot of our over 60-year-olds are going ahead, if they've already retired, they're taking the first quarter package on January 1st. Anybody who's under the age of 60 or wants the flexibility to see what the second quarter rates are going to be, they're waiting until March 1. And again, it comes back to that timeline where January 25th is when the package is due back. They're going to know what the second quarter rates are by the time it's due back in there. All right, I had a couple other questions come in, sorry. When they calculate the lump sum, do they take the present value of each monthly payment, or do they take the present value of the annual payment monthly times 12? I know the math can make some difference between the two methods. Hold that thought. I actually have an example coming up next slide here. So here's an example of just a current annuity payment of $4,773.25 per month, or $57,279. Now, we did this based on the non-grandfather category. So here's the three segments for the fourth quarter. So segment 1 was at 0.91, segment 2 was at 2.68, and segment 3 was at 3.4. Life expectancy was age 84, which means that you receive an annuity through the 83rd year. Now, one of the things we wanted to do was demonstrate the annuity calculation, how it applies, and the next thing you know, I'm going to talk about sensitivities here to interest rates. But for example, you can see the annuity payment in this column here, they're listed all the way down. That's the annual payment of $57,279. So obviously, if you take the annuity, that payment stays flat for the rest of your life. Now, back to how it's calculated from a lump sum perspective. So again, for the first 5 years, you apply segment 1. There is a discount factor that gets imposed per year based upon the actuarial tables. Then for the next 15 years is segment 2. and then everything else. So this goes back to the question that someone had if they were 62. So if they were 62 and retiring, they're going to have less exposure to segment 3. And same for somebody who's at 55, they're going to have more exposure to segment 3. Now, those discount factors obviously will still adjust based upon whatever your age is at retirement, but we're taking the present value back, and that's how you get the lump sum value. Obviously, this is a simple illustration because we were just showing $1 million lump sum number. We have built out pension tools to be able to do some analysis for clients. We have clients with different situations, whether it's separation from service or they might have a divorce that they've got quadros in place that we need to adjust. We've also been running different timing scenarios based upon interest rate sensitivities and potentially adding length of years of service or age to be able to show some different demonstrations of what happens to their lump sum benefits. Now, just to kind of continue and build onto this, I wanted to show what the sensitivity was from an interest rate perspective, if interest rates were to go up or to go down. So the general rule of thumb, and I'm using the same example from before, still using fourth quarter of 2020 discount rates, but the general rule of thumb is a 1% movement in interest rates is approximately a 10% differential to the lump sum, both up and both down. It's not quite a linear movement, but you can see kind of those fluctuations. So for example, in that $1 million lump sum case, if rates had gone up by a full 1%, it's about a 9.5% differential in terms of the lump sum value going down. And with what we've been experiencing recently, so if rates were to decrease by 1%, that $1 million actually goes to 1.109. So as I mentioned earlier, we're modeling anywhere from a 37 to 39 basis point decrease going into the first quarter. So we are anticipating lump sum values are actually going to get a little bit bigger. All right. A couple things in terms of when to consider delaying the pension. And I kind of mentioned this earlier on the one tangent I went down, I apologize. But if you do not need the money right away, and especially if you're under the age of 60 because of that early commencement discount that ExxonMobil imposes, and if you're taking the lump sum and expect interest rates to fall, those are the main reasons that we recommend delaying. And you don't necessarily have to be over 60 if you're taking lump sum and expect rates to go down. We've got a lot of our clients who are over the age of 60 right now that are actually already anticipating retirement, and because rates are going down, they're delaying into the first quarter just because of that. All right, so part of our process is to be stewards and translators of this data, but also helping with building out the timeline. And so I kind of was talking a little bit about the interest rates earlier. And what I was wanting to do was just demonstrate if you had a December 1 benefit commencement date, what some of those critical dates and critical execution steps are. Now, the earliest you can request a retirement package is 120 days out. They do recommend as early as possible, and I would also advise, given the level of volume, it's taking them a little bit of time to produce these intent to retire packages. Now, one thing with the intent to retire package, this is only talking about the pension lump sum. It's not addressing the 401k at all. That's a separate discussion I'll talk about in a second. But once you've decided what your retirement timeline is, you're going to need to inform your supervisor in writing of the 3 critical dates. That's last day on the payroll, first day of retirement, and benefits commencement date. So again, this is an example of using a December 1, 2020 benefit commencement date. 120 days out, the earliest someone could request that package is August the 4th. As I mentioned earlier, the latest someone could theoretically request that package is November 30th. Now, there's going to be delays on when everything would execute, but you do actually have that entire window in terms of when you want to be able to request that package. Now, it's taking them anywhere from 3 to 5 weeks for the typical package. If you have separation of service or you have a quadro, I could see that package taking as long as 2 months because they manually calculate the numbers. But once you receive that package, I really, really encourage, have it reviewed with your advisor. You know, one of the things I tell our clients is my team and I, we've done hundreds of these at this point. We are making some irreversible life decisions when we execute these packages. In terms of as we go through that meeting and walk you through the package, we are going to be executing it where I'm making the decision, if we're going to do lump sum versus annuity, and that's going to then dictate the forms that we're going to need. But lump sum, if we're going to go the lump sum route, we obviously need to sign and notarize the pension election form. If you're married, that's also where there's a spousal election form. You'll then need to fill out the qualified rollover form that also will require a notarization. If you're at the executive level, you'll have a non-qualified pension election form that also will need to be signed and notarized. You'll need to fill out an address verification form, as well as the direct debit authorization form. Now, as I mentioned earlier, in order to have everything processed on time, those packages need to be back to benefits 35 days prior to your benefit commencement date. And then typically that check will pay out somewhere around your benefit commencement date. Usually it comes in a few days earlier. I had a few things come in I wanted to comment. Someone had said they received their package in 7 days over a week ago, so they're getting them out fast. That's great to hear, because it's not really been the experience I've seen. But I imagine given the volume, they've added some personnel to get the packages produced pretty quickly. Another question had come in on how confident are you the lump sum option will not disappear anytime soon? Oh, great question. So this is one of the bigger rumors that we've heard over the last several months, that the lump sum would potentially be discontinued. To be honest, ExxonMobil has addressed this, or at least made comments to it. September 1st, they actually did a town hall meeting where there was a Q&A section, and they came out and they made a comment that they have no intention to discontinue the lump sum option, that retirement planning for their employees is one of their core principles, that they will not be discontinuing the lump sum. They did also indicate that on a go-forward basis that there would be changes coming to the pension program for anybody who didn't have at least 5 years of vested service. So I do think that it's safe to say that the lump sum will be going away, or the pension program, will be going away for younger, newer employees. But there's two ways of looking at the pension program as it's structured today. It is in a defined benefit plan. And in order to modify any of the options associated with the defined benefit plan, it is a full ERISA modification, which would take a tremendous amount of time, money, legal. And if they discontinued the lump sum option, I imagine that they're going to also have some regulatory hurdles that they would also have to overcome. The bigger concern I had was associated with ability to continue to fund the pension program. And what we do know is ExxonMobil publishes every single year the status of the funding of the pension program. They do post it. If anybody wants to see it, I have a copy of it. I can email it to you. But at the end of 2019, they had funded up to 97% of the pension program net credits. Credits is talking about fluctuations that are happening based upon interest rate movements. But as of the end of the year, 97% of the program was funded. Now, we have seen rates come down in 2020, which is causing the outstanding obligations to obviously increase a little bit. But if the pension program were to drop below 80% funding, ExxonMobil would then transition to 100% lump sum option to only being able to offer 50-50. If it drops below 60% funding, they can only offer an annuity. As part of that town hall meeting I referenced earlier, they also clarified they had no intention of changing the funding status of their pension program. So they do plan on continuing to keep the lump sum. Now, obviously, difficult times, their ability to continue to fund, that starts to come into question. But I would not change retirement timeline or planning based upon a bunch of rumors that are going on right now. A couple other things. For the lump sum, I know that the company must meet the minimum present value as required by government rules, segment rates, life expectancy. But I know that the company has the ability to use a more generous formula which produces a larger lump sum as long as it does it equal to or above the legally required minimum. Do you know if ExxonMobil's lump sum is based exactly on the government formula? Yes, it is. So basically what that comment is related to the grandfathered versus non-grandfathered math. They could have just kept everybody in the grandfather category if they wanted to. But obviously in 2007, they transitioned over to use the government rates. So essentially anybody who offers a true defined benefit plan that has a lump sum option is now using the same calculations, which is life expectancy as well as segmented rates. We do work with a lot of ExxonMobil clients, but I've got clients at other companies as well that also have pension programs. My mother-in-law retired from Merck. They use the same math as ExxonMobil does. I know Verizon's the same calculation as well in terms of the discount rates. Couple other things I wanted to hit related to the timeline. So I mentioned earlier that the intent to retire package is solely addressing the pension program. It also has some information about your medical. It's not changing anything in there, but it does provide some information. Now, separate to that is the conversation around Voya and what to do with your 401k. Now, you are not obligated or required by any means to take your 401k out of Voya once you've retired. There are probably some tax nuances we want to go through and understand before you make any level of decisions. For example, if you have NUA or if you have tax paid credit balance in some Roth scenarios. But once you do that, it typically takes 5 days after you retire before you're eligible with Voya, or they know that you're officially retired, in order to process that call. And again, same thing with completion of the lump sum package. I highly, highly, highly recommend having your advisor verify and be on that call with you. Same thing I've mentioned before, but we're making some irreversible life decisions here. Voya, unfortunately, I'd say majority of the calls I have with them, they have mistakes at this point. I think it's important to have somebody on the line who knows how to identify those mistakes very early on so that ultimately everything's executed correctly. But I just walked through some of the timeline here. I had another question come in. Have you heard anything concerning upcoming severance packages to encourage people to retire? Yes, I have. That's another big rumor that's going around. What we do know factually is that they've done something with Australia. They've also done something with Europe. I've been accused of being the rumor guy, so on a recorded webinar, I don't know if I really want to get into it, but I have heard different options where they're going to increase age, increase years of service, potentially do some cash inducement. I think the fact is that we know the company's in a difficult position right now, that they are going to need to do further headcount reductions. There is the HW3 that's going on right now to assess the needs of the company, targeting what different departments need from a personnel perspective. And I think all indications is that they're going to need to reduce employee headcount further. And in order to do that in a timely manner, they're going to need to do some type of separation or retirement commencement program. I'm happy to talk to you one-on-one offline. What is in-service rollover at 59 and a half? Do people do that? Does ExxonMobil still match if you do that rollover? So an in-service rollover at 59 and a half. So there's actually age 59 and a half is a critical age with regards to some of the options available to you. So when you're over the age of 59 and a half, you have the ability to roll over all three of the different aspects. So the before tax, the after tax, and the general account from your savings plan. You can roll any portion of those over up to the tax paid credit limit, and then any of the attributable gain off of it. Now, with the prior to the age of 59 and a half, you're only eligible to roll over after tax as well as general account funds. Now, why that matters is because we do, prior to the age of 59 and a half, we do what's called in-service withdrawals. And we do those because a good amount of our clients do put after-tax contributions into the savings plan. The reason that it's important is because it opens up the opportunity to get after-tax money over to the Roth. And that introduces that whole concept that I'd mentioned earlier called mega backdoor Roths. But it gets money out of the savings plan over into a Roth where it's growing tax-free, but we can still utilize the 401k to take advantage of all the before tax contribution levels and reduce your taxable income. So it's kind of a leveraging conversation that we have. That is part of our planning process, by the way. We're going to go through savings requirements or savings recommendations, and we'll talk about mega backdoors as well. Any thoughts on reasonableness of continuing group universal life once retired? Oh boy. So let me probably preface that question with everyone's situation is a little bit different. But my general guidance with regards to continuation of life insurance in retirement is that when you're younger, loss of income is a very big risk. If you're in your 30s and 40s, you've got kids, you've got a wife or husband, they're dependent upon you. Loss of income is a big risk. And so at that point in time, you need to keep large amounts of life insurance. And at the same time, too, more often than not, folks haven't had the ability to accumulate wealth in order to offset the risk of loss of income. Now, that said, as you get closer and closer to retirement and ultimately in retirement, the risk of loss of income is no longer as significant as it used to be. And so the need for life insurance becomes less and less and less. Now, for ExxonMobil households, ExxonMobil does pay for the basic policy for you, Once you've retired, there is an imputed income component. You do have the ability to convert it over to be a death benefit, so there's no imputed income. We can have that discussion as well. But with regards to the group universal life, I can see the merit on maintaining the group universals up to a certain point, dependent upon your situation. But one thing I'll caution on is those premiums essentially double every 5 years. So 55, they double, 60, they double, 65, they're double again, 70, they're going to double again. It does start to erode at the benefit that you're getting off of those life insurance policies. Now, if you have some type of pre-existing medical condition that would preclude you from getting any type of insurance coverage afterwards, and that's the only option, sure, let's keep it. But if it's something where we're just keeping it because it's inexpensive, I'm going to start to ask the question of what the need is. Because in retirement, the needs start to change. The loss, as I mentioned, loss of income is no longer a big risk, but you might have risk for long-term care or something of that sort. And that's part of what we want to have the conversation in terms of how we're deploying resources and what risks we're trying to hedge. All right, great questions though, thank you. So I am going to kind of start to summarize a little bit. So what I recommend right now is definitely have a plan, create a budget, understand your cash flow needs and anticipate future expenses. And let's have a conversation around risk profile. You know, with all of the uncertainty of the company right now, the number one thing I am recommending is have a plan. Put yourself in a position to be able to make decisions quickly, because I think that that's the only prudent thing at this point in time. Now, if you're close to retirement, you should already have a plan anyways, but if you don't, you really do need to have one. Now, we do have some upcoming webinars that we're going to be doing. Next week, I'm going to bring back one I had done earlier. You know, what if retirement comes earlier than you expected? On the 21st, I'm going to do one on NUA and post-retirement income strategies. On the 28th, I'm going to be doing one on why you need to consider Roth conversions now. I think this one's very timely given some of the conversations we're having around the election and potential tax changes that we might see, and being ready to have those types of, making those types of decisions going into the end of the year. Again, please take us up on the opportunity. If you haven't done so yet, have a one-on-one consultation. Definitely would love to visit and help. Here is our contact information. Myself as well as any one of my team members are always available to be a resource for you. And at the end of the presentation, as soon as I finish up, we do have a survey. I would love to get feedback. What could we be doing differently? Give us advice on different topics, things of that sort. But again, I'm recording this, so if you'd like to get a copy, please feel free. And if you'd like to send it to friends, feel free as well. But thank you very much. Stay healthy, stay well. We're here for you.